So this morning we were talking a lot about just different deals and analyzing deals. And now for the rest of the afternoon, we're kind of going to take it to how to fund the deals, where to get the money, because a lot of people say, I want to start real estate investing, but I don't have the money. So guess what? You don't really need to. This is where Alex Buriak comes into play. Alex is a former doctor and current senior vice president of business development at Jet Lending that has closed over 600 loans. He now focuses on growth strategies, product development, and market expansion. And Jet Lending, we used them when Chris and I first started investing. So, highly, highly recommend them. But Alex, I'll give you the floor now. So it's all yours.
Awesome. Well, thanks a lot. So we're gonna talk today a little bit about how do you fund any deal. Okay, and like the introduction, I am an asset-based lender. So I am a way to do business. I may not be the way, but I'm going to be a way for you to do a lot of volume and a lot of different types of acquisitions. So what I'm actually going to do is I'm going to share my screen here, and I'm going to go through in real time the actual dollars and cents about how you can get these deals done. Okay, so right here, you're going to see just a simple calculator here, and I'm going to go through either when you're trying to flip properties, if you're trying to hold them for rent, anything like that. Asset-based lending is an option for you to really get a lot of deals done, because how to get these deals done and funded, we're not credit based. It's not. It's all asset based. So we just want to make sure that you're profitable, and we're going to make sure that you understand what you're getting your business into. So all of those things is going to take into account how to fund the deals. So if you had a property, and let's say the purchase price was, we got it for 100 grand, okay, and let's say the after repaired value was 200,000. We had property taxes, $200,000 house, probably around 3%, so probably like $6 grand. And let's say you had to put $30,000 into that deal, okay, to repair it. So on an asset-based lender, we're going to hold up to 70% of the after repaired value, or I should say fund 70% of the after repaired value. So this is where it gets interesting. This is where you talk about volume, okay? How you're getting into 1, 2, 3, 5 deals at a time. And that's why people use leveraging accounts. That's why people leverage these assets to buy volume. So if you had this deal right here, you bought it for 100,000, ARV is 200,000, you have 30,000 repairs to make it worth 200,000. I'm going to lend you 140 on these structures. Okay, I'm going to take out $30,000 and I'm going to hold it in an escrow account. So when you do the repairs, I reimburse for completed work. So that means I lend 110 at closing, hold 30 in escrow. So if you bought it for 100 grand, okay, and I'm lending 110, that's where you hear 100% financing. You have 100% financing lender when you won't have any structured payments down. So how you fund every deal, especially in the state of Texas, Texas is unique. Texas is what's called a loan-to-value state. Most asset-based lenders have a loan-to-value component when you're funding these deals. So when you hear 100% financing, all that means is that you bought it for less than I'm funding at closing. So this is loan-to-value. One thing to watch for when you are doing funding these types of deals is there's loan to value sides of things, and then there's maybe a loan to cost rider. So so some lenders will say, hey, I'll lend you 70 or 75% loan to value, but I'm going to be at 80 to 90% loan to cost at closing, which means you come out of pocket either way. So if you have a deal and you need 100% financing, you need to find loan to value type structures, and you need to buy it less for what's being advanced to you at closing. So that's a main component to when you're structuring these deals. And I'm going to show you why. If you were to buy this house at 120, you're out of pocket now $15,955. Okay, so just a simple swing of how you bought it dictates what your out-of-pocket costs are at closing. Okay, so one of the things that you really want to pay attention to when you are trying to fund multiple deals is how much cash reserves you have. Now, a lot of times you'll have people come in and say, well, I want to get into real estate without any money. And you can, just like we discussed just now, you could be $0 out of pocket at closing, but you still have to have liquid assets. And the reason for this is there are things like holding costs. There's things like draw repair schedules, things like that, that you're going to have to use your money to keep the project moving. So one of the things that at least we try to do is make sure that you have at least 1/3 of the renovation budget, 6 months of interest payments, and anything out of pocket at closing somewhere in your liquid accounts to make sure that you can be safe in the deal. Well, the way that we're structured is we use a lot of regional bank lines and we lend that money out. So they lend it to us to lend out. So it does not behoove us to take the property back because that damages lines. So we really want to make sure that the investor can do the project, make their money, and do 20 more projects, because there's only 2 ways that a lender makes money: the origination and then the interest spread. So we want to make sure the interest and the borrowers do really well on their projects so they can keep buying. So as we're seeing here on something like this is how you can fund a nice fix and flip or even a rental that needs some repair. And what you do from there is we look at the rental side of things. So how you can fund any deal with a rental project is that there's something called debt service coverage ratio. And that's going to be your lead variable for anything that you try to do in rental real estate that's called non-QM or non-qualified mortgage. And what that means is it's very low doc. It does not have anything to do with your income or anything like that. Normally, in this market, you have about a 650 credit score minimum, where the short term, you didn't have a credit score minimum because it was solely based on the asset. But there is a long-term credit minimum, normally around 650 score. So the debt service coverage ratio comes into play. And what that means is if you had your principal, your interest, your taxes, your insurance, and any association dues, and that comes big when you are buying condos or townhomes. Something to really look for when you calculate your deals, because that can really spread how much you pay every month. What you do is you divide your rent by your monthly payment. And if your rent actually covers your monthly payment evenly, that's a 1-to-1 ratio. Most long-term lines are going to require at least a 1-to-1 to 1.3% ratio between the principal, interest, taxes, and insurance, which is your mortgage, and your rent. So it's going to make sure the property can stabilize itself and not be into debt. So when you're using non-QM long-term sides, it's really important that you try to get all that data in. Even if you're buying a property that needs to be renovated for rent, you need to be able to get that paperwork in, because normally long-term loans take about 30 days to close, where short-term loans are going to take anywhere from 7 to 10 days to close. In actuality, they close about 3 days from clear to close from title and appraisal reporting. When we look at everything, when you look at your deals to close, again, we're talking about how to close any deal and how to close volume. You always want to analyze your deals and think about how much profits you're going in, and Jet Lending will do that for you when we get into all of our processes. So what we want to do here is go over some questions and answers possibly here about anything that you guys have to do with funding deals, because there are so many different types of acquisitions and lending. I would like to go over any kind of questions people may have going over how to fund any type of deal with asset-based lending. All right, Jamie, I don't see any questions here or anything like that.
Here's one. How do you finance short-term rentals?
Awesome. Okay, so when you're financing short-term rentals, one variable that you always have to consider, on most either regional bank lines, if you want to do, if you're bankable and you can get in the regional bank lines, or if you're using the non-QM topics that we just talked about, you have to project the actual rent within the area. So comparable rents of, like, let's say you're buying a single family house in Galveston and you're going to Airbnb it. When you're doing your non-QM type 30-year lines, you're going to project that debt service coverage ratio with the local rents within the same square footage of the property, not the rents that you're going to get from your Airbnb or VRBO or other vacation type rentals. So always project the rents that you'll get monthly. There are some lines that are going to require you to have a lease. There are some that are not. As time goes by, you're noticing all the non-QM lines and all the regional banks are getting quite wise to how profitable this is. So over time, you're probably going to see these variables wax a little bit, but we close non-QM long-term rentals all the time. Just be aware that on the calculations, it's going to be used on the current rent data and not the vacation rental data.
Okay. Next question we have here is, do you have a flip to rental program? If so, what are the long-term rates currently? Estimate. Okay.
If yes, so flip to rental programs, you're going to be in your short term for anywhere from 9.9 to 11.9% interest only payments, where there's not a pre-penalty for early payoff. Your long-term non-QM refinance side of it, you will be depending on how many properties you've done in the past, your credit score. You're going to be anywhere from 6% to about 7.5%, depending on your experience, your credit score, and your debt service coverage ratio. The short-term side is a lot easier to analyze because there's really only one variable. The long-term side, there's multiple. So there's a matrix that we have to say, okay, this person has done this many, they've had this credit score, here's your DSCR, this is the interest rate. It's very cut and dry.
Okay.
Hey, Alex, I see another question here. Does Jet Lending lend to non-resident alien investors?
Yeah, so foreign nationals and things like that, yes. The only thing that we try to make sure is that any cash that's being used within the investment is actually in the States. So let's say we had a gentleman that was from Mexico, and he had all of his money in U.S. bank accounts. He was living here. It was perfectly fine. We had another person, they were actually, they're over in Europe somewhere, but all their money was also in Europe. We couldn't do it because if anything happened, you know, let's say they couldn't exchange the money, they were stuck. So as long as the person lives here, works here, has money here, yes.
Okay, fair enough. Fair enough. So yeah, y'all were pretty instrumental in. I mentioned whenever I was talking, whenever I brought Eddie up, like I was just calling, just trying to network people, and he was one of the numbers that I called. I didn't know who Eddie was, and I called, talked to him a little bit, and he goes, "Yeah, I own a hard." I think I was looking for private lenders or something. And he goes, "Yeah, I own this hard money company." And little did I know, I was talking to like one of the legends in the community, and he got us connected, and you know, it's very fortunate because we've built a great relationship over the time period, which has extended into other relationships like you and the Jet Lending team, and also funding our first few deals, including an apartment complex that was, I can't say without Jet we wouldn't have done. We would have figured something out, but y'all were a tremendous asset to us, both from the educational side, which really is more valuable, but also the financial side. It was great.
You know what, Chris, and that's a lot of stories and I really appreciate your stories began with us. But there's a lot of stories like that, it begins with private lenders and other hard money lenders and things like that. Wherever you're at in your business, whether you're starting out or you're really seasoned, my advice to you is when we're trying to go with the topic we're going, funding any deal, you have to have a lot of different lines and a lot of different types of monies within your reach. Okay, we are the one way to do it. We're really quick. We don't ask for a lot. It's really easy to do. Okay, as you grow in your business and you're buying apartment complexes and you're buying 5 houses at a time and things like that, we're still a really good avenue for you. But at that time, you're supposed to be getting into different bank lines and making relationships with private money and making relationships with regional banks and things like that. And that is really a good way to really scale in volume. Having a book of business of money to deploy out at your disposal when you have these investments come into play.
Mm-hmm.
They're tools. And we were at y'all an event that y'all hosted recently, and there was a very successful, they've done hundreds of deals, and y'all actually handed out a little gift to them for being, I think it was one of the, it was a cornerstone, I don't know, the 3,000th customer or something that y'all had done. I forget what it was, but
how many deals he did with them, you mean? That's why he got the.
Yeah. So, and I just show that to illustrate that you could be in this game for a long time and y'all are a tool. And at the end of the day, if y'all are the tool that helps solve the problem, you use it, right? You use it. I see a lot. I don't know. I see some people think that, I've got to save up the cash. I don't want to pay interest or I don't want to pay points. I'm like, well, you can do that, but how many deals are you going to lose out waiting for all that? Or how many can you really do?
Right. I mean, I know you guys had some people on for analysis and things like that. If you're making money, do the deal. The price of it, if you're, let's say, you're projected to make 20 grand on a deal, whether, your points and interest payments, all that stuff's calculated in the deal, do the deal. Keep making money, keep finding ways to get into this. And one of the things that I would like to stress, a lot of people come to me and say, Alex, I'm going to start wholesaling, which is the hardest thing to do when you're getting into real estate, but they don't pay attention to the financing side. Even Jet Lending, we do a lot of business with transactional funding for people to fund their properties that they wholesale. And when you're a person who sells property, when you understand the financing side of things, you can deploy more of your inventory to people buying quicker if you even understand how the money works. So even those people out there that are listening that are like, well, I'm going to start wholesaling, you need to really pay attention to the financing of stuff now, because your buyer is going to be using it. And you have to make sure that your buyer can close with this. So even if you're starting out and you're just kind of wholesaling too, please contact Jet Lending and lenders and stuff like that, and find out for yourself so you can one day buy them, but you can also know how to manage your deal.
Yeah. And one thing I love about Jet Lending, I always tell everybody about, because I always just reminisce on our first deals with Jet Lending when we were just completely new, is they kind of just hold your hand through the whole process, because they're lenders, but they're also investors. Yeah. So they know a good deal, and they really won't let you in a bad deal, because if something happens, guess who gets, the house or the property? They're not going to want to keep a dud. So, I always tell people that you just got to remember that these are the people to go to, because they know investment properties. They know the numbers, and they're a great, I say, teammate, person to have on your team whenever you're funding these.
That's great. Everybody, even right now, everybody right now is on the same team trying to make everybody money.
Mm-hmm.
Love it. Hey, well, appreciate everything Jet Lending does. The education and the events that y'all been putting out over the years is just worth absolute gold. And we've taken notes just with Johnny, with you, with Eddie, and just working with you and the Jet Lending team. So we appreciate it.
We have one question pop up if we have.
Yeah. Okay. Well, let this be the last one.
One more minute.
Okay.
What mistake do you see from a lot of investors?
Real quick, you run out of cash and you don't listen to your teammates about value. You listen to the person trying to sell you the property and tell you that it's worth more than it is. And you got to realize your lender doesn't make money unless we close the deal. If your seller says it's worth 500,000 and we're telling you it's worth 410 because it's near a busy street and commercial, listen to us, please. And so we can make sure that doesn't mean we're right or wrong, but we've done over 3,000 loans. We have a good idea of what's going on. Listen to your team. Make sure you have enough cash to move forward.
Love it. Love it. Thank you so much, Alex.
Thanks again. We really appreciate it. Have a great day.
You too.
You too.